couple of things to think about with products, Ben, is you've got fixed versus variable.
Yep.
And that's important. You've got line of credit and you've got an offset account. They're three key things that we need to understand if you want to be investment savvy. And we talked about these things in our book, The Armchair Guide to Property Investing, How to Retire in 2000 a Week. But those are important things to understand when you're wanting to borrow money and understand what is right for you, isn't it?
Yeah, that's right. I mean, the most important thing when we're looking at variable loans is variable loans are effectively set by the banks. They fluctuate over time. There's a relationship usually with the cash rate set by the Reserve Government, and it's the margin between the cost of the money and what they're lending it is how the banks make their money. Now, that's different to where they source their fixed money, and that fixed money usually comes from 5-year, 10-year bond rates and those types of long-term money market pricing. And then ultimately, if they come down, they can offer more opportunistic fixed rates of 1, 2, 3, 5, in some cases even up to 10 years. So we're always saying, you know, with fixed rate, it's always difficult if you are going to continue to build out your portfolio to lock in a fixed rate. But you can split price. So that is the most important thing that people need to understand. You can split those in terms of what that looks like.
Yeah, you can. So you can have a bit as a fixed rate and a bit as a variable. So you can dive into that a little bit more too. Now, line of credit, Ben, that's like a big credit card. So essentially, we talked about equity back here.
Yep.
Imagine if you could release some equity and use it like a credit card. It's essentially what a line of credit is, but quite often the interest rate's a little bit higher. So it's important to understand there is a place when a line of credit could make sense, but you could also release some equity and then just put it into an offset account and actually have just a standard variable loan that might be cheaper while still having access to your funds. And if it's in a 100% offset account, which is essentially the money that's in the offset account is offsetting the interest that you're paying on the principal loan. So if you're able to do that, it might be a better way to structure your lending so that you can actually take advantage of a lower rate while still having liquidity so that you can access it for deposits and solicitors and costs and all those sorts of things. So there's a time and a place for those, but it's important to understand that for us, we think that an offset account is one of the key money management tools, let alone lending tools.
That's right, and I think the other big play that's happening today in the product space is the cost of money is also being sort of bucketed into principal and interest versus interest only. So you need to also understand that when you're investing, ideally the lower cost base you can get, the more assets you can potentially control. So we've obviously been a big fan over the journey of interest-only lending because you're in control of liquidity as opposed to principal and interest, which means that in a technical sense the loan is amortising over time. So there's a principal portion of the loan that you're paying out over the journey. So more can be said about this.
More could be said about that.
I think we're going to explore those in a future upcoming webinar.
We are, Ben, but what I want to quickly talk about is ownership over here.